Let's hear the fundamental case. Dick Bove is back with us on the phone, Senior Research Analyst at Odeon Capital Group. Dick, good to have you back on the show as always. Last time we spoke, you were waxing pretty bullish on some of the banks. Now we've got a little price action leadership around this kind of partial reflationary trade and hopes for tariff resolution. How does this all fit together coming into earnings?
Well, I think most people think that earnings will be moderately higher for the banks this quarter. I think they'll do better than that. I think that if you break down product by product, you can see that there's been some pretty good action in banking. In other words, there's been an awful lot of IPOs, which benefits the investment banks. Trading has been slightly better this year than it was last year in the third quarter. Consumer borrowing, particularly in the auto area, has picked up dramatically. And you've got this mortgage refinance boom that has been going on, which hurts in one sense, and that is that the mortgage servicing income will go down, but there's an awful lot of origination profits coming in. And then, of course, you've got some of the weaknesses, which would be the corporations are not borrowing as much money as they had been, and that hurts the Midwestern banks. And you've got this big issue over whether interest rates are going to cause a major reduction in their margins, which I don't think will happen. So when I net everything out, I think that this will be a pretty good quarter for the industry.
Yeah. We're looking at a chart from your report on loan growth to back up what you're talking about here. 12 months, the blue bars versus the annualized 90-day growth rate. We saw a little bit of reversal in at least one section on C&I loans, but for the most part, this still looks pretty robust to your point, Dick.
Yeah, in other words, if you think about banks the way you would think about any commercial companies, in other words, they're in business to sell products. The products that they sell are loans, and if loan volume continues to go up, bank earnings are going to continue to go up. Now, again, we always have to put the caveat in because of the interest rate environment, but I do think that, it works in both fashions. In other words, the banks are going to show big profits on their holdings of securities, and the industry owns $3.4 trillion worth of securities because the decline in interest rates has bolstered the value of those securities. On the other hand, they may show some erosion in margins, and that I think will be dealt with hedging strategies.
So one of the parts of this market that has slowed down a little bit, I think kind of reflects the overall manufacturing hit that the U.S. has taken. If we go back to your table for loan growth, it's the commercial industrial loans that are the ones that have flipped over the past 90 days. Are there banks in particular that are most exposed to that kind of economic slowness, Dick?
Yeah, absolutely. In other words, if you take a look at companies like Comerica, which have an extraordinarily high percentage of commercial loans as a percentage of their total loan portfolio, and they're looking at troubles both with the fact that their loan volume is probably disappointing, and because they're very what they call asset-sensitive banks, they are very exposed to interest rate issues. Fifth Third, Key Corp, Huntington Bank Corp, Regions Financial, these are all Midwestern banks where, commercial lending is their primary product. And I think in the cases of all those companies, you're looking at some difficulties. And again, on the flip side, Capital One not only is a big credit card company, but it is the third largest auto lender in the United States, and they're on the beneficiary side. Goldman Sachs, Morgan Stanley, they're on the beneficiary side. So if you think of banks, again, as product sellers, and you take a look at the individual products and you match them to specific banks, you come away with, positives on some and slightly negatives on others.
When we look at the big Wall Street firms, Dick, if we look at mergers and acquisitions, M&A activity, IPO equity offerings, and more, what's interesting from your report is I see Goldman standing out on both of these metrics in a pretty solid way for the third quarter 2019, particularly on the M&A front. Wells Fargo was also active here, but what I'm curious about is the hold rating you've got on GS, despite some solid numbers here, it looks like, in performance this last quarter.
Yeah, I think that I'm going to be wrong. I think short run on my Goldman Sachs hold recommendation, because I think that Goldman Sachs had an extraordinarily good quarter. I think that Goldman, jumped to the top, not just emerged or evolved. It jumped to the top of the league tables on IPOs. It did a really good job on M&A. So I think in that regard, it will be helpful. The whole recommendation is related to other things that they're doing. I don't think their consumer business is going to work pretty well. I think they're going to lose money on it. I don't like the credit card deal they made with Apple. I think that Apple, if Apple demands and the suppliers agree, it's kind of like Walmart says to the supplier, this is what we'll do and you'll do it. I think that in the case of the Apple-Goldman deal, that's what's happening here, so I don't see Goldman making very much money there. In addition to which, there's been so much turmoil in the management ranks of the company. Literally 1 out of every 6 of the top management people at Goldman Sachs have been fired in the last 30 days. And, I don't see, and that's we've got a new CEO, a new CFO, a new COO, a new CIO, a new head of human resources, a new head of a whole bunch of trading operations. When you go down through the ranks, they've cleaned house and put a whole new group of people in, and I think that's destabilizing to a company.
Dick, one more before I let you go. JP Morgan is the standout on the charts right now after being the first to break out higher. What's it going to take for you to get bullish on JP around the earnings?
Well, I think JP Morgan has made the decision that we're going into a recession. In other words, if you take a look at the quarterly reports, in the first and second quarters, it's clear that JP Morgan has made the decision to slow down its loan originations, to sell a bunch of loan portfolios, to step back from being aggressive in the market. Jamie Dimon has actually said, publicly, if my loan salespeople don't have a good quarter, that's fine with me. And I think he's really expecting a recession. I think he set that bank up for recession, and therefore what I would like to see in answer to your question is a big jump in loan sales, and that would make me a buyer.
All right, really good stuff here in the case for the banks here. As it's been a competitive quarter. Looking forward to seeing how it turns out. Dick Bove, appreciate you joining us. We're going to do a little trading here. Tom, so a hold on Goldman Sachs. Yeah. Tell me how you'd look at kind of executing a neutral trade on Goldman.
Well, volatility is elevated into the report tomorrow morning, Oliver. I think the option market's pricing in a plus or minus about 3.5% move in Goldman Sachs, which is higher than a lot of the other banks in this space. So it's telling you that volatility is a little bit more elevated in the stock. Shares are up 22% year to date. It's been outperforming, but it's got some good points on it. But to Dick's analysis on this company, if you look at it as a hold, well, how can you play that using options to make a trade based on going into earnings tomorrow morning? And what I came up with was a simple credit spread, and it's an iron condor, Oliver. 2 short vertical spreads on this particular trade to take advantage of that higher elevated volatility while giving yourself a nice big range for Goldman to trade in over the next 11 days. I went out to the October 25th weekly series, and I sold the 190, 192.5 put spread, and then sold a call spread above the current share price near 204 at the 212.5, 215. So $2.50 wide on each vertical, each short vertical. I collect roughly about an 85-cent credit on that. So $2.50 wide on each of them, 85-cent credit. My break-evens are about 191.65 on the downside, so over $10 below the current share price, which is outside of that expected range of plus or minus about $7. And then 213.35 on the upside is my break-even. So I'm outside of the expected market maker range.
Okay.
And I expect volatility to fall 10 to 20% from current levels after this report comes out. As long as it's not a huge
swing here, you're good.
Yep, exactly. So it plays it for a neutral type strategy to take advantage of that elevated volatility, and also you collect time decay, where the price of that iron condor contracts on a daily basis. You get to buy it back cheaper over the next 11 days, and that's the thought on a neutral type strategy. Okay,
so for Goldman, where Dick Bove's got a hold, let's shift over to a few of the other names, because he is bullish on Wells Fargo. Right. He's also bullish on Citi. What are you looking at?
Well, I looked at Wells Fargo because it's only up about 6.5% year to date. It's severely underperformed, but there's reason for that. They've got a lot of issues, not only management, but they've got some restrictions on their capital that they can expand that was put in placed by Fed Chair Yellen before she left. But that being said, I looked at his thoughts on Wells Fargo and then loan growth. Housing's doing really well.
Right.
Who takes
had a good
advantage of
M&A
that?
quarter too.
Yeah. Who takes advantage of that? Wells Fargo does.
Yeah.
So I looked at something really simple. Because the stock pays a 4% dividend and it's relatively inexpensive, around $49 a share, I just looked at a simple covered call, Oliver, where you buy the stock, you get to take advantage of that 4% dividend yield.
Okay.
But then also you sell a call against it. And what I did was go out to the November 1st weekly series, about 17 days to expiration, and sold the 51 strike, which is currently about $2 out of the money to the upside, so it gives you some room up there. You pay roughly about $48.75 debit for that covered call, so you're buying the stock basically below where the current share price is, because you get that premium from the option that you sell against it, but you still get to collect the dividend because you're buying the stock. Capital intensive on this one, but this is for a longer term play where you can roll those short calls week to week or month to month to collect more premium, reduce your downside break-even point, and increase your potential profitability on that trade. So that's why you sell a call against just owning the stock outright. Increase that yield on a position that you already want to own. So that's a way to take advantage of it if you're neutral to bullish on Wells Fargo going into earnings.
Yeah, all right, there it is. Tom White, nice here executing the strategy. Thanks to Dick Bove from Odeon Capital.